So picture this. It's the fall of 2008.
Oh, man. A rough time.
Right. And some of the most profitable, like seemingly invincible companies on the planet just straight up died in a single weekend.
Yeah, just vanished.
And the crazy thing is, their products were still great. Their sales metrics were still super high. Consumers still actively wanted what they were selling. But they collapsed overnight because of a fatal misunderstanding of, well, one single concept.
The timeline of their debt.
Exactly. The timeline of their debt. They had made the catastrophic mistake of funding these massive 30-year physical assets, things like real estate and, heavy infrastructure with 30-day commercial paper.
Which is just, it's a recipe for disaster.
Right. So when the short-term credit markets froze, the music just stopped. And despite having literally billions in assets, they couldn't make payroll on Monday morning.
It is a terrifying reality of corporate history. We tend to focus obsessively on revenue, right? Or, marketing, product design.
Because that's the flashy stuff.
Exactly. It's the fun part. But none of that matters if the foundational capital structure is flawed. A maturity mismatch, which is basically borrowing short to build long, is essentially just a ticking time bomb built into the balance sheet.
And that brings us to our mission for this deep dive. Because look, if you're listening to this, you are likely an MBA student staring down a massive corporate finance exam.
Unit 2, specifically.
Yeah, Unit 2. And we know you're feeling the pressure. So today we are tearing apart the anatomy of long-term finance. We're going to build a comprehensive, totally bulletproof mental framework of how capital is actually sourced, structured, and deployed.
And we are drawing this material directly from those core textbook chapters so you can, walk into that exam room with absolute confidence.
Okay, let's unpack this, because finance isn't just numbers on a spreadsheet, right? It's the actual lifeblood of any business.
It really is.
It dictates whether a company survives or perishes in the market. But we aren't just going to sit here and read definitions to you. We need to understand the underlying mechanics. Because whether you are stepping into a boardroom or, launching a startup or sitting for this high-stakes exam, you have to understand that choosing a funding source is a highly strategic decision.
Right. It dictates who actually controls the company, how much it truly costs to operate, and whether the business can survive a macroeconomic shock like we saw in 2008.
Yeah. So before we memorize where to get the money, we need to understand why a business needs it in the first place and exactly what constitutes long-term.
Right. So let's draw a very strict perimeter around what long-term actually means in this context.
Okay, let's set the playing field.
When we talk about long-term finance, we are looking at a financing horizon that begins at anything over 1 year and extends, all the way out to 30 years, and sometimes even beyond that.
Wow, okay, so anything past 12 months is officially long-term territory.
Exactly. And this is fundamentally distinct from short-term financing. Short-term debt is really meant for temporary liquidity smoothing.
Like paying your electric bill while you wait for a client to pay you.
Right. You use it to pay your suppliers while you wait for your customers to pay their invoices. Long-term finance, on the other hand, is the heavy machinery of the balance sheet. It is deployed when a business faces a massive structural need for capital that, cannot possibly be covered by this quarter's cash flow.
Okay, so let's map out those structural needs for the exam. Why does a company willingly strap itself to a 30-year obligation?
Well, the foundational framework usually points to 5 distinct scenarios. And if you're taking notes, you'll see they actually follow the chronological lifespan of a successful enterprise.
Which makes it easier to remember, actually. So it all begins with the startup phase, number 1.
Right. Starting a business is the most obvious capital void. You are standing in an empty lot, and you need to construct a factory, purchase raw materials, and hire a workforce.
And you have zero money coming in.
Zero. The critical financial dynamic here is what we call the cash flow valley of death. You are incurring massive capital expenditures and daily operating costs long before the first widget rolls off the assembly line and generates a single dollar of revenue. So you need a deep reservoir of long-term capital just to survive that runway between inception and commercialization.
Makes sense. Okay, so scenario 2. Let's assume you survive the valley of death. You eventually hit capacity. You're selling everything you make, but you just can't make enough. So that triggers expansion activities.
Yes, expansion. But keep in mind, this isn't just about building a second factory. It's often about entirely overhauling the underlying technology to beat your competitors.
Oh, right, like buying new tech to cut costs.
Exactly. Expansion is frequently driven by the need to fundamentally alter the unit economics of the business.
Mm.
So you might be replacing like labor-intensive legacy equipment with automated million-dollar robotics.
Which is a huge upfront cost.
Staggering. But the theory is that the new tech will drastically reduce your marginal cost of production. It lets you undercut competitors. However, because that upfront investment is so massive, it might take, 5 or 10 years of those incremental cost savings to finally break even on the machines.
Right, so you can't fund that with a 6-month loan.
No way.
Yeah.
That necessitates long-term financing. You need a loan whose lifespan matches the payback period of the asset.
Okay, so we have starting up and expanding. Scenario 3, developing and marketing new products. So you've automated your factory, you're crushing the local market, but eventually your core product gets commoditized, right? People reverse engineer what you're doing.
Yeah, so you're forced to innovate, and the pharmaceutical industry is actually the perfect case study for this.
Oh yeah, because of the R&D costs.
Right. A pharmaceutical company might spend 10 years and billions of dollars developing a single new compound. They run it through endless clinical trials, test it in pilot markets, and throughout that entire decade, that specific drug is generating zero revenue.
It's just burning cash.
It's a massive cash incinerator. So you need patient capital. Money that understands the return on investment is a decade away.
Okay, scenario 4, entering new markets. Once you have that new product, you want to sell it to entirely new demographics. But I imagine this isn't just about, like, shipping a few boxes overseas.
Far from it. Entering a new geographic market, like exports, or targeting a completely different customer type requires heavy infrastructural investment.
Like setting up new retail shops.
Yeah, retail setups, ad campaigns. Say a domestic brand decides to expand into Europe. They have to navigate foreign regulatory environments, build new regional distribution centers, launch massive, localized marketing campaigns, and sign long-term commercial leases for retail space.
So you're basically building a parallel business from scratch.
Exactly, which requires a dedicated long-term funding silo.
Got it. And that leads to the 5th and final pillar. Probably the most aggressive reason for needing massive capital, takeovers or acquisitions.
Right, inorganic growth. At a certain point, it just becomes cheaper or faster to buy your competitor rather than outcompete them. When a corporation executes a takeover, they are buying an entire functioning entity. Its assets, its customer base, its intellectual property.
And you can't just put a billion-dollar merger on the company credit card.
Definitely not. It requires highly sophisticated syndicates of banks providing term loans or the issuance of new equity on the public markets.
Okay, so for the exam, remember the 5 pillars. Starting up, expansion, new products, new markets, and takeovers. But it brings us back to the failure of those companies in 2008. Why is it so structurally important to use long-term finance for these moves? The textbook framework suggests 3 big structural advantages.
Yes. Stability, flexibility, and productivity linkage. You absolutely need to know these 3.
Okay, break them down for us.
Let's start with stability, because that is exactly what the companies in the financial crisis lacked. When a CFO is planning for the next decade, they need absolute certainty regarding their debt obligations.
They need to know what the bill is going to be.
Right. If you secure a 20-year loan at a fixed interest rate, your repayment schedule is locked. There's no sudden margin call. There's no panic about the bank demanding the entire principal back next Tuesday because, macroeconomic conditions got tight.
So stability gives you peace of mind to actually execute the strategy.
Exactly. It removes the constant panic.
But wait, doesn't being locked into a 20-year contract inherently destroy flexibility? I mean, if you are bound to a 30-year schedule, how is flexibility considered the second advantage? That seems contradictory.
It sounds like it, but that's actually a really common misconception. The flexibility doesn't come from breaking the contract. It comes from the sheer variety of instruments available in the long-term capital markets.
Oh, meaning you can customize it up front.
Precisely. Unlike a standardized short-term line of credit, long-term financing can be heavily tailored before you sign. You can structure complex covenants. You can utilize lease agreements, mortgage refinancing, convertible debt.
So you can perfectly match the loan to your specific business model.
Exactly. A skilled corporate treasury team can fine-tune a long-term debt instrument to fit the exact cash flow eccentricities of their firm.
Okay, that makes sense. And the third advantage, productivity linkage. That seems to tie this all together.
It does. It goes right back to the concept of maturity matching. Short-term finance is for things that are consumed quickly, like raw materials. But long-term finance is deployed to acquire capital assets, things that physically produce the revenue.
Like a new factory.
Right. A factory, real estate, industrial machinery. These assets fundamentally expand the operational capacity of the firm. They actively produce the revenue that will eventually pay off the debt used to acquire them. The debt and the asset's productivity are inextricably linked.
I want to use a personal finance analogy to make this stick for the students listening. So short-term finance is like using a credit card to buy groceries, right? You eat the food, it's gone, you pay the bill at the end of the month. But long-term finance is like getting a 30-year mortgage to buy a house that you're going to rent out for profit. The house itself generates the rental income over decades, which slowly pays off the 30-year mortgage.
That is a phenomenal analogy to solidify this concept. If you tried to buy that rental house with a 30-day credit card, you'd go bankrupt before the first tenant even moved in. The maturity of the debt must match the lifespan of the asset.
Perfect. Okay, so we understand the timeline, the operational triggers, and the structural necessity. So let's move into section 2. We've established the why. Now the deep dive shifts to the where. Where do we find the money?
Right.
And the most logical first step for any business is to look inward. Look in its own pockets before asking outsiders for cash, which brings us to internal sources of finance.
Absolutely. Before a management team subjects themselves to the scrutiny of public markets or the rigid covenants of a commercial bank, they look at their own balance sheet. And the most dependable, prominent internal source of long-term capital is retained earnings.
Retained earnings. Okay, let's walk through the actual accounting mechanics of this for the exam. Where does this money actually sit?
It starts at the top of the income statement with total revenue. You subtract your operating expenses, your depreciation, your interest payments on existing debt, and finally, your corporate taxes.
And what you're left with is PAT, profit after tax.
Exactly. This is the net income that officially belongs to the equity shareholders. Now, the board of directors faces a critical decision. What do we do with this pile of cash?
They can pay it out or keep it.
Right. They can distribute it directly to the shareholders as a cash dividend, or they can retain it within the company. When they choose to keep it, it is transferred into a general reserve account on the balance sheet. That is your retained earnings.
But the board can't just arbitrarily decide to keep everything, can they? I mean, what are the actual determinants? If you get an exam question asking what determines retained earnings, you need to list these 4 things.
Yes, write these down. There are 4 primary determinants. The first is almost painfully obvious, the absolute quantum of profits.
Yeah, you can't retain what you don't earn.
Exactly. If the company is operating at a loss or barely breaking even, retained earnings are off the table. The second determinant is the legal and regulatory provisions regarding dividend payments.
Meaning the government steps in.
Right. Various jurisdictions have statutory requirements about how profits must be handled, especially concerning minority shareholder protections. The third determinant is the corporate tax rate.
Because retained earnings come from profit after tax.
Exactly. So the sovereign tax rate acts as a massive filter. If a government suddenly hikes the corporate tax rate from 20% to 35%, the pool of capital available for retention shrinks dramatically, regardless of how well the underlying business performed.
Wow, okay. And the fourth determinant, the dividend payout policy. This one feels like the most volatile variable because it involves human psychology, right? Market expectations.
It is arguably the most complex dynamic in corporate finance. Management must constantly negotiate the dividend payout policy with their investors.
Because different companies attract different types of shareholders.
Precisely. Take a mature utility company. They attract retirees and pension funds who rely on a steady, predictable quarterly dividend to fund their lives. If that utility company suddenly announces they are cutting the dividend to 0 to retain earnings for, say, a speculative green energy project,
Those shareholders will absolutely revolt. They'd dump the stock immediately.
they would. The stock price would plummet, the board would likely face a proxy fight, and the CEO might be fired. But conversely, look at a high-growth software company.
Right, like a tech startup. They never pay dividends.
Exactly. They might explicitly state in their prospectus that they will never pay a dividend because every single dollar of profit is being relentlessly plowed back into R&D to capture market share
And their investors are totally fine with that.
because they are chasing capital appreciation. They want a rising stock price rather than quarterly income. So the dividend policy dictates the retained earnings, and the policy itself is dictated by the specific culture of the shareholder base.
Okay, so Assuming the company has a healthy profit and a shareholder base willing to let them retain it, let's talk advantages. Why use retained earnings instead of going out and raising new money?
The advantages are immense. First, ready availability. The capital is literally already sitting in the company's treasury accounts.
No waiting around.
Zero time delay. You don't have to wait for regulatory approval, and you don't have to spend 6 months trying to convince a syndicate of banks that your new factory will be profitable.
And it has to be cheaper, right? I want to emphasize the friction costs of external finance because I don't think students always realize how expensive it is just to ask for money.
That is a crucial point. External financing involves massive transactional friction. If you want to issue new equity to the public, you have to hire an investment bank to underwrite the offering.
Wait, stop right there and define that for the MBA exam. What is an underwriter actually doing in this context? Why do they charge so much?
Okay, an underwriter, usually a major Wall Street bank, acts as the intermediary between the company issuing the shares and the public market buying them. They analyze the company, help determine the initial price of the shares, and crucially, they often guarantee the purchase of the shares.
Oh, meaning if the public doesn't buy them, the underwriter is stuck holding the bag.
Yes, because they are taking on that massive pricing and distribution risk, they charge a hefty underwriting commission. We are talking tens of millions of dollars, or a percentage of the total capital raised. Add in legal fees, accounting audits, the cost of a global roadshow to pitch the stock.
And retained earnings bypasses all of that.
Completely. Zero flotation costs, zero underwriting fees, zero legal filing costs. Every single dollar goes directly into the physical asset you were trying to build.
It also preserves the power structure, right? No ownership dilution.
Exactly. If you issue new shares to outsiders, the existing shareholders suddenly own a smaller percentage of the company. Their voting power is diluted. By using internal profits, the existing cap table remains frozen. The founders maintain their exact same grip on the steering wheel.
And doesn't it also send a really strong signal to the stock market?
A very positive connotation, yes. Relying on your own profits signals tremendous financial strength. It proves you're a cash-generating machine, which actually boosts your creditworthiness for future borrowing.
Okay, so let me hit you with a strategic exam question here. If retained earnings are basically cost-free because there are no underwriting fees and they don't dilute ownership, why wouldn't a company just keep 100% of its profits forever? There has to be a dark side.
The dark side is a massive corporate governance issue known as the agency problem.
The agency problem. Explain that.
Because retained earnings are so easily accessible and don't require external validation, management teams can start treating it like free money.
Right, because they didn't have to bleed for it in a pitch meeting with a bank.
Exactly. When you go to a bank for a $50 million loan, the bank acts as an incredibly strict, objective filter against bad ideas. They stress test your projections. If your plan is flawed, they won't lend you the money, effectively saving you from yourself.
But with retained earnings, the CEO just bypasses that entire reality check.
And they often do. An overconfident management team with a massive pile of retained earnings might decide to acquire a failing competitor just to build an empire, even if it makes zero economic sense. They found reckless pet projects. This destroys shareholder value.
Plus, it relies entirely on the accuracy of profit calculations, right?
Yes, profits are an accounting calculation, not an immutable physical law. Your income statement might show a massive profit due to aggressive recognition tactics, but your actual bank account might be light on cash. Committing to a massive project based on paper profits can trigger a huge liquidity crisis.
Okay, that is a perfect balanced view for an exam essay. The lack of friction is its greatest advantage and its greatest vulnerability. Now, before we move on to external sources, there is one other internal source to briefly touch on: the sale of assets.
Yes, selling property, machinery, or even logos or patents to fund new projects.
But that has to be super limited, right? You can't just sell your main factory to build a new one.
It is severely limited. First, you can only sell surplus assets. Second, corporate assets are often highly illiquid. There is no ready market for a custom-built chemical plant. You can't rely on it when you're in a time crunch, and it's not available to all companies.
All right, so let's assume we hit the wall. The internal pockets are empty. We've exhausted retained earnings. We don't have spare factories to sell. But we still need $100 million to expand. We have to look outward.
Section 3. The external routes.
When you step out into the capital markets, you are essentially standing at a fork in the road. You have two fundamental choices. You can either sell a piece of your soul, or you can sign a blood oath. You can sell ownership or you can take on debt.
That is a very visceral way to frame it, but highly accurate. The most profound decision the capital allocator makes is choosing between equity and debt. Let's explore the ownership route first.
Let's start with the bedrock. Equity shares, universally known as ordinary shares. When someone buys an equity share, they are buying a literal, legal fraction of the company.
Yes, they are the real owners. And the absolute defining characteristic of an ordinary equity share is that it carries a residual claim on both the income and the assets of the firm.
Okay, residual claim. That is a massive concept. Let's unpack that carefully because it dictates the entire risk-reward profile of the stock market. Residual means what is left over.
It means they are at the absolute back of the line. From an income perspective, equity shareholders only receive dividends after all operational expenses have been paid, after taxes, after bondholders get their interest, and after preference shareholders take their cut. The board looks at the residual pile of cash and decides if they want to pay a dividend at all.
There is no fixed burden, no legally mandated rate of return.
None.
And it's even worse in bankruptcy, right? Think about a corporate liquidation like a sinking ship. The court takes over, sells the scrap metal. Who gets paid first?
The secured creditors get paid first, then the unsecured bondholders, then employees, suppliers, preference shareholders. Only after every single other legal entity has been made completely whole does the ordinary equity shareholder get to look at the remaining pile of scrap.
Which is usually empty. They get wiped out.
Completely wiped out to zero.
Okay, I have to push back here. If I am sitting at the absolute back of the line for profits, and I am guaranteed to be wiped out in a bankruptcy, why on earth would I ever buy ordinary equity? It sounds like an atrocious deal.
Because of the asymmetrical upside. It's true your downside is capped at losing your initial investment. But your upside is mathematically infinite.
Unlike a bondholder.
Right. A bondholder who lends $1 million at 10% only ever gets $1 million plus 10%. Even if that startup becomes a $3 trillion global monopoly, the bondholder doesn't get an extra penny.
But the equity shareholder captures all of that residual value.
Every single dollar of value created beyond the fixed debt obligations accrues entirely to them. That is the trade-off. You accept the ultimate risk of ruin in exchange for the uncapped, unlimited potential of the enterprise. And to compensate for that risk, equity shareholders are granted voting rights proportional to their paid-up capital. They control the board.
So from the company's perspective, what are the advantages of issuing equity?
First, it provides permanent capital. You never have to repay it during the company's operational lifetime. Second, there's no fixed dividend burden, so it acts as a safety cushion against bad times.
And it actually preserves creditworthiness, right?
Yeah. Yes, because it doesn't put a charge on company assets. Your factories remain unencumbered, meaning you can easily get a mortgage from a bank later if needed.
Okay, that's ordinary equity. But here's where it gets really interesting, because there is a middle ground, a hybrid instrument that lives between the rigid world of debt and the chaotic world of equity. Preference shares, the VIP slices of the corporate pie.
Preference shares are fascinating. They are designed for investors who want higher yields than bonds, but don't want the terrifying volatility of ordinary equity. They carry two very specific preferential rights.
They get to cut the line.
Exactly. First, a fixed dividend paid before ordinary shares. And second, priority repayment of capital during winding up or bankruptcy.
Okay, so why would a company issue these?
Lower cost than equity, capital structure flexibility, and crucially, no dilution of management control. Preference shares generally have limited or zero voting rights.
Ah, so the founders keep control. Now, for the MBA student, this next part is an exam goldmine. You need to memorize the 4 pairs of preference shares. Let's drill these into your memory using clear contrasts. Pair number 1, cumulative versus non-cumulative.
This is about unpaid dividends. If a company has a bad year and can't pay the dividend, do those unpaid dividends accumulate and get paid later? If they're cumulative, yes. They build up as arrears and must be paid out in a good year before ordinary shareholders get anything.
And if they are non-cumulative,
They disappear. If you don't get paid this year, that money is gone forever.
got it. Pair number 2, redeemable versus irredeemable.
This is about the timeline. Redeemable shares mean the company can buy them back or redeem them after a fixed period subject to Companies Act restrictions. Irredeemable means they are permanent.
Pair number 3, convertible versus non-convertible.
The magic switch. Can the holder magically transform their preference shares into ordinary equity shares? If they are convertible, yes. They can trade their safe fixed dividend for the unlimited upside of ordinary equity. Non-convertible means you stay a preference shareholder forever.
And the final pair, number 4, participating versus non-participating.
Do they get to dip into the surplus profits after everyone gets their fixed cut? Participating shares get their fixed dividend, and then they get to participate in the massive surplus alongside the ordinary shareholders. Non-participating just gets their fixed rate and nothing more.
Awesome. Keep those 4 pairs straight for the exam. But what if giving up ownership or surplus profits just sounds totally unappealing to the founders?
Then you go down the debt route. Section 4, debentures and bonds.
You borrow money with a strict promise to pay it back? Break down debentures.
They are fixed interest, fixed-term investments offered by companies. But understand, they are not risk-free. They carry default risk, meaning the company might go bankrupt. And they have a strict maturity period. Returns are based on official interest and loan rates.
Okay, now we arrive at the absolute mathematical core of corporate finance. If you are building a mental model, focus on this. The tax shield math. This is crucial for MBA students. Why is debt mathematically superior to equity from a cost perspective?
Because interest is a tax-deductible expense. Dividends are paid from profit after tax, but interest is subtracted before you calculate your tax bill.
Let's walk through the specific math example from the text. Say you have a 12% debenture and a 30% corporate tax rate.
Okay, so you pay 12% in interest, but because you deduct that from your taxable income, the government essentially subsidizes your tax bill by 30% of that interest cost.
So the effective cost is much lower. Let's do the formula.
The formula is the interest rate multiplied by 1 minus the tax rate. So 12% multiplied by, in parentheses, 1 minus 0.30.
Which is 12 times 0.7.
Exactly, which gives you an effective cost of only 8.4%.
That is a massive advantage. You are paying 8.4% instead of 12%. Write that math down for the test. Okay, just like preference shares, we have the 8 types of debentures grouped into 4 pairs. Let's run through them fast. Pair 1, record keeping. Registered versus bearer.
Registered are on the company books. The company knows who you are. Bearers are transferable by physical delivery. Whoever holds the paper owns the debt.
Pair 2, security. Secured versus unsecured.
Secured or mortgage debentures are backed by company assets. If they default, you take the factory. Unsecured or simple debentures have no collateral.
Pair 3, timeline. Redeemable versus non-redeemable.
Redeemable are paid back after a fixed period. Non-redeemable are paid only on liquidation.
And pair 4, transformation. Convertible versus non-convertible.
Convertible can be turned into equity shares. Non-convertible cannot.
Simple. There are also 2 other debt forms to briefly mention. FCCB, foreign currency convertible bonds, which tap into international markets but carry currency risk, and standard mortgage loans, secured by real estate. Which moves us beautifully into Section 5, term loans and the IDBI exhibit. We are moving from public debt instruments to institutional borrowing. What is a term loan?
Term loans are provided directly by commercial banks and financial institutions. They can be secured or unsecured. They don't dilute ownership, and the maturity is over 1 year.
But the bank doesn't just hand over the cash, they put you through the ringer. There are 2 technical requirements.
Yes. Projects must establish technical feasibility, meaning the engineering actually works, and economic viability, meaning it will actually make a profit in the market.
And repayment is based on a very specific ratio, the DSCR.
Debt service coverage ratio. It compares your cash generation to your debt obligations. You need a high DSCR to prove you can make the periodic installments.
But what if you are building a massive factory and it takes 3 years? You have no cash flow yet.
This is a vital feature, the repayment holiday. During project implementation, banks grant a grace period where you don't have to make principal payments.
That is huge. Now, the text gives us a concrete case study. The IDBI Bank Term Loan Scheme, Exhibit 2.1. Let's break down the categories.
IDBI categorizes loans. First, greenfield projects, which is building a new facility from scratch. Brownfield projects, which is expanding an existing facility. And non-project loans, which is just buying fixed assets like equipment.
And how do they calculate interest rates? Because this involves macroeconomic risk.
Rupee loans use the BBR, the bank base rate, plus a fixed spread based on risk. Foreign currency loans use floating rates based on LIBOR, the London Interbank offered rate, plus a fixed spread.
All dependent on creditworthiness, risk perception, and tenure.
Awesome. Okay, we've covered the traditional stuff. Let's move to Section 6. Specialized financing. What happens when a business is too risky for a bank or they need equipment but don't want to raise capital?
We look at venture capital and leasing.
Venture capital or VC. High-risk, high-return financing for early-stage, high-potential tech startups. Think biotech, IT, software, right? Because traditional banks won't touch them. VC features equity participation, meaning they want a huge ownership stake, a long-term horizon, and crucially, active participation in management.
Let's unpack this quote from the text because I love it. Venture capital combines the qualities of banker, stock market investor, and entrepreneur in one.
It's a perfect summary. They provide the capital like a banker, they seek capital gains on exit like an investor, and they actively manage the company, sit on the board, and fire executives like an entrepreneur.
Highly invasive capital. Okay, on the SIP side, we have lease financing for companies without capital market access to use assets without debt or equity.
Yes, the mechanics involve the lessor, who owns the asset, the lessee, who uses it, and the lease rental payment.
And the major distinction here, lease payments often occur at the beginning of the year, giving businesses time to generate funds, whereas debt payments often come at the end.
Exactly.
But we need to strictly contrast the two types of leases. Financial versus operating lease. This is definitely on the exam.
Okay, financial leases are long-term, non-cancelable, and transfer title at the end for a nominal cost. You're basically buying it over time.
And operating leases.
Short-term, revocable. The lessor handles maintenance. They're used for high obsolescence items like computers and trucks. You just use it and give it back.
One quick clarification. How does leasing differ from hire purchase?
Good question. In hire purchase, the hirer gets the goods immediately and pays installments inclusive of principal and interest. But actual ownership title only transfers upon the final payment.
Boom. Okay, we've done it. So what does this all mean? Let's do a rapid-fire summary to build that mental map for your exam.
You need to map out internal versus external sources, retained earnings versus raising new money.
You need to know ownership versus debt, the infinite upside of ordinary equity, the VIP status of preference shares versus the tax-shielded power of debentures and term loans.
And don't forget the specialized options, VC and leasing, for when the traditional routes don't fit. Exam writers love to test the contrast between all these.
Exactly. And before we go, we want to leave you with a high-level analytical question to ponder based on the text's view of venture capital.
Right, think about this. If venture capitalists must act as a banker, an investor, and an entrepreneur all at once to succeed with high-risk startups, does the traditional, rigid separation of these financial roles even make sense anymore in our fast-moving, high-tech economy?
Is the old way of banking dying? It's something to think about. Good luck on your exam, and thank you for joining this deep dive into the lifeblood of business. We'll see you next time.